Nikkei-225, home of alternative economics and contrarian views. Well, we're going to look at Japan today. Economically, it looks okay. Their stock market is going gangbusters. Their currency not so good. The debt not so good. The inflation or the rising prices not so good. Politically, there's a little bit of positive news, but I think it could actually be very negative in the medium to long term. Before we start on Japan, I'd just like to thank all the viewers for your interest in the channel. And for those of you who haven't subscribed yet, think about subscribing. Make sure if you enjoy a particular video that you hit the like button and you share it. Just wanted to give a shout out as well to one of our long-term affiliates, Dirty Man Safe. In this day and age where the world's getting topsy-turvy, where even governments are coming after your wealth. Case in point, the Netherlands, where they've passed a capital gains tax based on how much your portfolio has gone up. It's not if you buy something, sell it, and make the profit. They wanted like unrealized profit capital gains. That's very serious. What's that got to do with Dirty Man Safe? Well, when governments are coming after you and your property, you can bet the petty criminals are going to be doing the same. So it's a good way to hide, secure your most cherished valuables. Have a look below in the description. There's a link there to our landing page and you get 10% off Dirty Man Safe. So back to Japan. Well, I've been covering Japan here pretty much since I started the channel back in late 2015. I have a playlist, the Japanese yen carry trade. And I've been warning that Japan could be the first domino to fall. And what I mean by that, well, the yen could be the first currency to collapse into a crack-up boom or hyperinflation, loss of confidence in the currency. Pretty much what happened back in the Weimar Republic after World War I in Germany, and pretty much what happened in France, revolutionary France in the 1790s. And the problem is always the debt. And the debt results from a major crisis. And in Japan, it was in 1989 when their real estate bubble collapsed, their stock market collapsed, and their banks were going to collapse. So what did the government do? Well, they bailed out the banks. They have been printing a lot of money left, right, and center. They've increased fiscal policy, heavy government spending. They've kept the banks alive. The term zombie bank comes from that period in the early mid-90s in Japan. And the flip side of that is that the currency gets very weak, the cost of living rises, and in real terms as well, the currency buys a lot less, and you get to a point with the general public, the people who don't have a lot of assets, and the younger people, they get fed up. And so Japan, they were the ones who started. They were the pioneers in QE, quantitative easing. But the Bank of Japan, along with the government, started this policy after this collapse. The debt, though, has gotten totally out of hand. Yes, they've kept it going since then until now, since the early 90s. But the public debt in Japan is 252% of GDP. I mean, in the US, it's around 123, and it's still a lot, but this is double. What else has happened in Japan? Well, back in 2013, Shinzo Abe, who became prime minister, Japan was still in the doldrums, especially after the '08 crisis. And he put these policies that I've spoken about from the early 90s, and he put it on steroids. And the Japanese yen carry trade, what that means is that the Japanese have kept, the Bank of Japan has kept rates at zero, basically, since, for like last 20, 25 years. They have started raising it right now, but it's still below 1. It's like 0.75%. And what that does is that pushes all the other major countries, their investors and financial institutions, to borrow in yen. So when you borrow in yen, you're selling the currency, you're getting the proceeds and putting it into dollars, euros, pounds, whatever other currencies. And then you buy riskier assets. And your hope, of course, is that the yen doesn't appreciate and that rates stay low. And that's still happening now, the Japanese yen carry trade. But the problem is that they've always used the excuse in Japan that there was a danger of deflation. And by deflation, I don't mean the money supply dropping. I mean the Keynesian definition that CPI would be negative. And it had been zero and negative, the Japanese CPI. If you look here, since 2016, we've had a few periods of negative, but warning and scaring people about deflation is the way that they've kept inflating, right? Because the money supply in Japan is still really high. And now what you're getting actually is actual price rises, very strong price rises, as you can see here since 2021. It's been in the magnitude, well, pretty much roughly around 3%. And when you have rates at zero, investors are getting ripped off. And that's why the JGB market, which is more longer term rates, that's why the prices of those government securities, of which half is owned by the Bank of Japan, that's why they're collapsing in price. That's why their yields are going up quite sharply. And what that does, that increases the Japanese government's interest payment expenses, especially with a debt at 252% of GDP. Granted, yes, the BOJ owns half of it. They could just write that off, but they won't, of course. And now with a new prime minister, she called a snap election, did very well. And guess what? She's going to push for even more Abenomics. That's her hero. Fiscal policy is going to continue to be very strong. She's going to cut taxes for food, which is understandable because with the weaker yen, with all the inflation they've created monetarily, people are suffering. The cost of living is a lot higher. And the BOJ, funnily enough, they're still doing about 200 billion yen, I think a quarter. Every quarter of QE. So they haven't stopped, even though they've raised rates begrudgingly. Yes, I see that they're doing 200 billion per quarter into 2027. Yeah, they have tapered it from 400 billion through early this year, right? What this is doing is that this is driving a lot of money into the stock market. And I was surprised the other day because I remember last April, stock markets had a really tough time because of that Liberation Day in the US. And the Nikkei prior to then had just risen back above 40,000, which was the all-time high from late 1989. And then it crashed basically almost back down to 30. But then the Japanese, they've stepped in. The public monetary and fiscal authorities. And you can see that we're now at 57,000. This is not healthy. This is, I think, investors fleeing the government bond market, the JGBs. They're fleeing the yen, and they're going into things, right? Because companies produce things. They have factories. They have real estate and everything else. And yes, they have ships. They have buildings. So I think Japanese investors, they are concerned about the currency. And you might think, well, the currency hasn't gone down that much, but let's look at this chart here that I prepared of the yen, because we can compare it to what the yen did in the 70s. And as you can see, the yen strengthened pretty much in the 70s and up until 1989, 1990. Of course, this chart is dropping because it's the dollar dropping. The dollar was 380 yen, and by 1989, it was almost at 100. So that was more of a healthy growth in the stock market, even though it got out of hand, of course, towards the end, and it all collapsed. It got too much of a good thing. But now, as you can see, since Abenomics, the yen has been weakening, which means the dollar's been rising. The dollar got down to 77 yen, and we're now around 160, and it looks like we could go higher. So it's not healthy economic growth. What they're doing is financial repression, very blatant and very severe. By financial repression, I mean they're keeping short-term rates still at zero while prices are rising by 3-4%, and they probably tinker with those price rises as well. It's probably more like 4 or 5 in Japan, and that's for the basic necessities of life, and that's why they've had political problems. The other chart I wanted to show you, that I've shown you many times before, is the chart of the Japanese yen, the chart of gold, in Japanese yen. I mean, it's been a one-way street, really, except for the period between 2013 and 2019. The Japanese yen has really been losing or being debased, because gold, as hopefully you know by now, is the best store of value, store of wealth, measure of wealth, really. The dollar doesn't do that. The dollar is, I guess, a good form of payment and trade and pricing value, like in the commercial world, but even that is losing out. But as you can see, the yen has gone, the price of gold has gone from around just below 30,000. We're almost at 1 million. I mean, we're at 763,000 yen to the troy ounce. And I think it's only a matter of time. And this means the yen is dying. So Japanese investors, they're fleeing the currency. And when you flee the currency, you flee the bond market as well. And you go into anything but the yen. So you go into gold. That's the opposite of the yen. It's real money. You go into the stock market. You're buying companies, real businesses. And if we look back to the 1920s in Weimar Germany, the same thing happened. People went into companies, but the best place to have gone was gold, because companies do well, but not as well as gold, because there's no counterparty risk. Anything but the yen, that seems to be what's going on. And unfortunately, Japan has been the poster child for all these reckless monetary and fiscal policies, and we're following them. You can bet this is going to happen in the United States, in the UK, and Western Europe. And it all boils down to the debt, right? We keep bailing out Wall Street. Japan bailed out their Wall Street equivalent back in the 90s, their banks, the real estate. Politicians hate seeing pain, right? So they keep kicking the can down the road. And I'm going to finish off with what von Mises said about the crack-up boom. And I've got this, I've showed you this many times before. Are we there yet? Well, we're getting closer and closer. In Japan, I think we're almost there. So what is it all about? Because you can call it the hyperinflation crack-up boom, and it's got nothing to do really with cost push inflation, even though the cost push inflation gets us there. Hyperinflation is more something psychological. You lose faith and confidence in the currency. And I think people like Ray Dalio are warning about that. People like William White, former head economist of the BIS, he's saying that gold is becoming money. He should have said again, but he says people don't trust the dollar, don't trust the yen, don't trust the euro, the pound. So let's go through this. But then finally the masses wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. A breakdown occurs, the crack-up boom appears. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. Within a very short time, within a few weeks or even days, things which were used as money are no longer used as media of exchange. They become scrap paper, and I added scrap digital entries. Nobody wants to give anything away against them. It was this that happened with the continental currency in America, 1781, with the French mandat territoriaux, or assignats as well, in 1796, and with the German mark in 1923. It will happen again when the same conditions appear. If a thing has to be used as a medium of exchange, public opinion must not believe that the quantity of this thing will increase beyond all bounds. Inflation is a policy that cannot last. So yes, as I said, anything but the yen, and by that I mean the government bonds, the cash as well. Of course, you might want to keep a bit of cash, but I think Mrs. Watanabe would be putting her family's savings in peril by keeping JGBs and keeping yen balances in the bank. Hopefully Mrs. Watanabe is loading up on gold and silver. So with that, I'm going to wish you all a very good day. Take care. Bye.